Holy guacamole, you guys, there's just so much going on right now that just keeps piling up against us. We have banks tightening lender standards, game-changing new regulations on banks that don't help the situation. We have demand going down and inventory at all-time highs, record theft at retailers, renewed worries about another inflation uptick sending us into stagflation, and the list goes on. So we got a lot to talk about, but for the most part, I want to talk about the changing policies and what regulators are doing. But check this first. America is broke. Robert Kiyosaki warns that a crash landing is coming, and he says that the Fed has been smoking fantasy weed. He thinks that despite recent gains in the stock market in 2023 and a few better than expected GDP reports, things aren't too peachy. Don't they know that the stock market is up because Biden raised the debt ceiling? America's debt is going up, so the stock market is going up, he wrote in a tweet. America is broke. And he goes on to say that he prefers gold and silver and Bitcoin. Now, if it were just the stock market going up because the debt was going up, then maybe it wouldn't be so bad. You know, after all, we're in a debt-based economy. But let's take a look at something else that might cause him and the rest of us to be worried. Here's some demand for you, or lack thereof. Let's run through this, and you'll see where this demand issue is going to tie into this banking fiasco, and where you'll find that the regulators either aren't too bright or they're up to something mischievous. Let's take a look at this non-farm productivity. Remember, we technically had a recession early last year with 2 consecutive quarters of GDP. But what we should see coming out of a recession or a slowdown is an increase in productivity as those unproductive workers become more productive and there's enough demand and work to validate. They're being more productive, but what happens if you see a downturn and it stays down like we're seeing right now? You see here, it's kind of rebounding now. And while that is an indication of a recession, we see such a trend every time there's a recession. But what I'd like to show you here is that you see here, back in 1970, we saw this dip, and then there was a recession. The dip began in the beginning of the recession of 1975, and again, it happened prior to the recession of 1980. Now, it isn't always indicative as a recession, as we can see. This really didn't happen during the 2008 financial crisis, nor during the dot-com bubble. But the dip is so far down now that it could be concerning. Couple that together with the fact that we saw less of an increase of GDP last quarter, and this quarter could be worse. And who knows, it could very well be negative. But hopefully, this does mean that inflation is likely to come down. Some disagree, but I'll get to that in a second. But another thing that this indicates is that as the trade industry, the freight industry, and the shipping industry has been screaming to us that the global economy is slowing down. And that means that workers aren't going to be more productive. That means they're not going to get bigger raises, and in turn, inflation will come down. And with that, Warren Buffett may be bracing for a recession, and Michael Burry's latest big short is a good move, says top economist Steve Hanke. Berkshire Hathaway sold a net $8 billion of stocks and added to its cash pile in the second quarter. Warren Buffett and Michael Burry have rattled financial markets with bearish disclosures this month. Steve Hanke says that they're most likely preparing for some trouble. Yeah, well, we should too. Berkshire Hathaway sold a net $8 billion of stocks and slowed its pace of buybacks last quarter, sparking a 13% rise in its money pile to a near record $147 billion. It's also consistent of his long track record of piling up cash in anticipation of storm clouds ahead, with the capacity to pounce on bargains once the storm hits. And you know, that really is a good plan. You know, one of the things you should do once you've paid off all your debt, if you do have your debt paid off, you should really, I like the word here, pounce. You know, it refers to a cougar just pouncing on you. Like if you meet up with one of those, you know, wild cats in the wild and you're looking straight at it, you don't want to look away, you want to back away, but keep your eyes on him, because as soon as you move your eyes, he'll pounce on you. But that's what you really got to do. If you want, when the market goes down, if you're all set, if you have, you know, all your loans all paid off, you don't have any credit card debt, you have cash available, yeah, then you look for those bargains, because in a few years, those stocks are going to go up again and you're probably going to make a killing. But I want to go into this, because we definitely all should be concerned, because in a moment you'll see what I'm getting at with this banking mayhem that I've been talking about. Bank of America sees trouble ahead for tech stocks despite big inflows. Strategists of Bank of America Global Research see second half trouble for technology stocks even as the sector took its took in its largest inflow in 10 weeks. B of A pointed to a correlation between a surge in central bank liquidity and the NASDAQ over 15 years. But central bank balance sheets are down $3 trillion, yet NASDAQ wants new highs. We say tech equals second half trouble rather than an era of new AI rules, said Bank of America in a note. And now we have game-changing regulations that are coming to banks, and this is going to have a shocking impact on consumers. And I mean, it's going to make getting a loan an outright nightmare. But that's only part of the story, because wait until we see what impact these regulations have on our financial system and on the broader economy. Big banks will need to hold more capital to guard against risks on their new Fed proposal. We need to understand why this is such an important topic, because the role of banks in our financial system, in our debt-based system, is to lend money, because we need the creation of new money to pay off old debts. So anytime you see new regulation that comes along and tries to slow down a bank's ability to create new loans, it all of a sudden, it means the economy is just going to move slower and slower. And in this case, new capital requirements, it means that banks, they're going to have to stop lending as much, and they're going to have to put more money into reserve. So the nation's biggest and most complex banks will need to hold an additional capital on their balance sheets on their initial proposal by the Federal Reserve and FDIC. The proposal takes aim at those banks between $100 billion and $250 billion in assets, which have been among the most impacted by banking panic that started in March of this year with the collapse of Silicon Valley, the Signature Bank, and First Republic Bank. Fed policymakers have said repeatedly that there needs to be more supervision of these big but not gargantuan institutions. The banking industry had a hostile reaction to the Fed's proposal. No kidding. Banks have long contended that they hold more than enough capital to withstand even a global financial crisis, pointing to the COVID-19 pandemic and other industry reforms since 2008, such as the Fed financial stress. The industry's main argument is that any capital that has to be warehoused on a bank's balance sheet is capital that cannot be used to fund loans, to make trades, or to return profits to shareholders through stock buybacks and dividends. Yep. And now we see here that we're adding fuel to the fire. During already troubling times, while we seem to be hanging by a thread and bracing for the next black swan to hit us, we have to deal with new regulations like this. And what we're also seeing here is that when you have to withhold more capital and you have to put it in reserve, well, guess what? You also have to buy back that capital, and you're not going to put it in cash. You're going to go out and buy treasuries. Now you think about it, with the debt ceiling being raised, as Mr. Kiyosaki mentioned, we're actually going to see a future where $30 trillion in debt is going to become $50 trillion in debt. And by golly, who best to make the banks absorb a whole bunch of it? And one thing this is going to cause is it's going to cause a lot of banks to merge, which isn't a good thing. But what I want to ask you is, do you think the banks need more regulation here? Do you think this is the proper response that we just saw to this crisis that we had earlier in the year? Do you think there's something else we should do, or just nothing else we should do? Let me know in the comments. But one of the issues here, and apparently the regulators don't understand, is you need more banks in our financial system, because it's a debt-based system, and in this system you need money to move. So when you think about taking a loan from a bank and you deposit it to pay somebody else, if the bill is paid at the same bank, it really does nothing for the system. What you want is for that money to go to a completely separate bank, and for that bank to lend against that deposit. And then that money goes to another bank where it gets lent again, and then it multiplies throughout the system, throughout the financial system, throughout the economy. That's how you get inflation. That's how you get money growth. That's how you don't get a recession, and apparently the regulators want to do the opposite. And then when you look at this next chart, it tells us why bank mergers are one of the worst possible things that we could experience if you want money to multiply in our economy. And you see now, this has been discontinued, but it's a number of commercial banks in the United States, this red line, but it really doesn't matter, because as we know, this line keeps going down. And this is a money multiplier, which is the M2 money supply divided by the monetary base. So as we have more banks in the system, the money gets multiplied through it, which leads to, of course, creating sustainable inflation and money growth. So as we get rid of more banks, which is what we do through regulation and mergers, what it means is that less money is getting multiplied through the system. And now all of a sudden you have a huge problem. And why do they want this to happen? But from a lending perspective, it's also a big problem for consumers. Because if banks are withholding more money in their capital requirements, it means they have to start cherry picking even more who they're lending to. And the small to mid-sized bank failures that we saw recently, Why do the big banks not want to see those lower banks fail? Why do they actually inject capital into Silicon Valley Bank? Because those banks can originate loans because they're not subject to all of these requirements. The moment the banks get subject to this, what you're going to see is a lending collapse, a money growth collapse, a money multiplying collapse. And where do you think the economy is going to go? Well, it's not going to go riding off into the sunset, I'll tell you that much. Another thing I wanted to touch on real quick is all this retail shrink. And even though I want to briefly touch on it, I don't want to diminish the gravity of this situation. This is big time bad news that probably deserves its own video. Dollar General expects a $100 million headwind from theft. You can find headlines like these all over the place these days. $100 million in just Dollar General alone. Retail theft is in the billions of dollars a year. And you know what this means, right? You guessed it. Companies going to recoup their losses by passing that loss on to us. Definitely not going to make life easier for us. And as I mentioned, stagflation might be a thing again. It was a concern at the beginning of the year, and now, as the service sector fails at the same time as the manufacturing sector, growth of business activity in the U.S. came to a stalling halt in August, this article says. Manufacturing slipped into decline after a brief resumption of growth in July. But make no mistake, stagflation is even more difficult than recession. That's when you have stubborn inflation that doesn't want to come down at the same time as a recession. Again, another video on its own. I did make an awesome video about stagflation a few months back. Check in the pinned comments for that.